First, we're asked to calculate the return on investment. We should remember that formula is the operating profit divided by the capital employed. So I can simply divide the operating profit by the capital employed for JC, which comes out at 0.2 or 20%. And I'll do the same for GC, giving me 15%. Next, I'm asked for an alternative, my residual income calculation. So for residual income, we'd simply take the operating profit of 700 or 675 for GC and deduct an imputed interest charge. That's based on our capital employed multiplied by 10%. So for JC, that's 3,500 at 10%. So 350 of interest to deduct, and for GC it was 4,500 at 10%, so that's another 450 to deduct. That leaves us with our residual income figures, 350 and 225. To calculate the market share for JC, we need to look at how much sales JC has in proportion to the market as a whole. Well, we're told that 50,000 of sales have been generated by JC compared to 2.5 million within the total market. So it looks like JC holds 2% of the total market. That just leaves us with our asset turnover. Asset turnover, we know, is sales divided by our capital employed. So for GC, we've got a total of 60,000 of sales revenue, which is being generated by capital of 4,500. So that's a turnover of 13 times. To score the final 4 marks for this task, we'll need to be able to deal with the discursive sections. So we're asked for 2 disadvantages of using residual income as a performance measure. One of the problems we have with residual income is that it's difficult to make comparisons between divisions of different sizes. The figure that we produce is an absolute value, the number of pounds or dollars or euros of return we have generated in excess of the required return. It doesn't consider the size of the initial investment that went into that. So there's our second problem. It's not relating directly to the size of the centre. Okay, a larger centre is likely to generate larger incomes and therefore hopefully have a higher residual income. So difficult for us to draw comparisons and not recognising that difference in size. The final 2 points then we know must be incorrect, but let's have a quick look at why. So it doesn't make the divisional manager aware of the cost of financing their divisions. Well, one of the main advantages of residual income is helping to keep divisional managers alert to that financing cost by requiring them to calculate an imputed value for interest. And not directly related to the net present value. Well, it isn't directly related to the net present value, but that isn't a significant disadvantage of the residual income method. Not everything has to tie into NPV in order to be valuable to us. So that leaves us with the final 2 marks in task 3, looking for some non-financial performance measures. Hopefully the number of new customers and the percentage increase in market share jumped out as both being non-financial, whereas return on sales and the sales revenue to each customer would both be measured in financial terms. So we might be looking in dollars or pounds or euros. So we cannot include those.